Goldman Sachs lifting its odds of a U.S. recession to 35%, now expecting 3 rate cuts from the Fed this year amid those concerns about slowing growth. Meantime, the market pricing in at least 3 cuts this year as well, with the first coming in June, according to the CME Fed Watch tool. Here to break down what's next for the central bank, we've got William Dudley. He's the former Federal Reserve Bank of New York president. Thank you so much for being with us this morning here. As we mentioned, we've got recession risks increasing here from Goldman Sachs, from Yardeni Research, other banks lowering their growth forecasts in really quick succession here. To what degree are you concerned about a potential recession?
Well, I'm concerned about higher inflation and slower growth. So that's what's putting the Fed in a very difficult dilemma. They're going to be missing on both sides of their dual mandate objectives. The inflation is going to be too high, and the labor market's going to be on the softer side. I think the key is going to be what happens to the unemployment rate. If the unemployment rate goes up significantly, then the Fed will ultimately cut interest rates. But one thing that people are missing is that it's going to take a very, very slow payroll employment growth to push up the unemployment rate this year, because the labor force is growing much more slowly than it has over the past few years. Virtual shutdown of immigration into this country, deportations, very slow growth of the working age population for people who are born here in the United States. So labor force growth is going to be, 2 or 0.3% after rising 1.5% to 2% over the prior couple of years. So I think people are misunderstanding the fact that a slowing in economic growth isn't necessarily going to lead to rapid Fed rate cuts if the unemployment rate doesn't get pushed up significantly.
So it sounds like you're painting what could potentially be a worst-case scenario where we have a stagflationary backdrop, but a Fed that is hamstrung in its ability to cut rates because we may not see unemployment following suit. Is that a correct characterization?
Yeah, I mean, I think the problem is that, if growth is weak enough, then you don't have to worry about inflation. But if growth is not weak enough, unemployment rate doesn't fall, and then inflation basically hamstrings the Fed. I think what we're going to see from the Fed is the Fed's going to basically be sitting on its hands for quite a while until they see which way we break. I very much disagree with your prior person on the show, because he said that the tariffs are only about net imports, which are $1 trillion. No, they're about gross imports, which are nearly $4 trillion. The tariffs are going on all imports, not net imports. So the impact of the tariffs on imports is going to be much more significant than he said. I would say basically about 4 times the magnitude of what he presumed. The thing that's important about the tariffs is twofold. Number one, the increase in tariffs this time is dramatically bigger than what happened during the first Trump term. First Trump term, tariffs went from 1.5% of imports to 3% of imports. Looks like this time we're going to go from maybe 3% of imports to 15% of imports. So that's a 12 percentage point increase compared to a 1.5 percentage point increase. The second really important difference is inflation that was below 2%. Inflation expectations were really well anchored. We've been running inflation above 2% now for 4 years. This will be the 5th year of inflation above 2%. And there are some signs that inflation expectations may not be quite as well anchored as they were a few months ago.
Bill Dudley, I'm so glad that you and I get a chance to converse. I'm a big fan of yours. You may not be one of mine, but I am a fan of yours. And I would like to just try to figure this thing out, this tariff thing. What if, I'm going to play the devil's advocate, what if where there is some sort of scenario where effectively it's a game of chicken and the other countries say, you know what, we're not going to stick with our 10% tariffs, as an example, on your American cars that come over to Europe. We're going to cut to 2.5%, which is what you charge us. What if this is actually just a giant negotiation and we've gotten so fixated on the worst case scenario that it's not as bad as we actually think?
It's possible that it could go that way, but if you look at the run of news over the last 3 months, every month we've been thinking that the tariff increases are going to be bigger, more persistent. I mean, I think the fact that the Trump administration is, taking on Canada is a sign that they're really quite serious about tariffs. I mean, what did Canada do to deserve this? We do not have a big immigration problem of people coming over the border from Canada. We don't have a big drug problem of drugs coming over the border from Canada. Canada is integrated with the U.S. economy, and then we're potentially blowing up that integration. So I think that this is not being done in a really careful, thoughtful way. Now, there are times where tariffs make sense when you're trying to protect national security, or you're trying to protect industries that are just getting on their feet. But broad-based tariffs against everybody, regardless of how they behaved, that doesn't seem like good policy to me.
And I wonder how you're thinking about the consumer in this environment. We've obviously seen sentiment falling off a cliff, but we've seen over the past couple of years that sentiment and consumer spending don't always align. We're very resilient when it comes to our ability to swipe the credit card, I guess. To what extent do you think that the consumer might start to really be impacted by all of the headlines and concern about tariffs, and that could be a catalyst to push us into a broader slowdown?
Well, I certainly agree that sentiment doesn't is often not a really good predictor of what spending actually turns out to be. I think the problem here, though, is higher prices are going to mean a squeeze on income, especially for low and moderate income households that are already under strain. So I think you're going to see some softening in real consumer spending just because people's dollars won't go as far as they went before because prices will be higher. I mean, just think about the tariffs on cars. I mean, we're probably going to push up car prices by somewhere on the order of 5 to 10 percentage points. So cars are going to become less affordable, so people will buy fewer cars. It was interesting last week, you saw a rally in Hertz stock because the value of their used car inventory is all of a sudden much higher because people are assuming that the tariffs are going to increase the demand for used cars. So you can see these ripple effects through prices that I think are going to lead to weakness in consumer spending. Now, the problem we also have is it's going to be very hard to read the economic data over the next couple of months. Some people are buying now to get ahead of the higher prices that are going to be occurring because of the tariffs. So you could actually see a situation where consumption was pretty strong for a month or two as people basically tried to buy things now at a cheaper price rather than the higher prices that will be in place later.
Right.
We'll know a lot more. We'll know a lot more tomorrow when we see what April 2nd actually turns out to be.
Hopefully we'll get a little bit more clarity tomorrow, at least if you're an investor right now. I've got to ask what you make of the path forward for the Federal Reserve this year. What are you thinking in terms of rate cuts? If you were a voting member, what would you be thinking? And would you agree that inflation is transitory?
Well, it's transitory if it doesn't get into wages. That's the real key thing. And that question is, can the Fed get away with another year of above 2% inflation without inflation expectations becoming unanchored? You know, it's sort of a chicken egg problem. If the Fed stays tough, then inflation expectations won't become unanchored. If the Fed is much more dovish, well, then that increases the risk that people don't think the Fed is credible on inflation. The Fed's been very fortunate and over the last few years that even though we've had bad inflation expectations have stayed well anchored over this period, but you sort of wonder how many years can you keep this going? This will be the 5th year with inflation above the Fed's 2% objective.
All right, Bill Dudley, thank you so much for coming on. Hope to have you back soon. Appreciate it.
Thank you.